Welcome back. Still watching Hot Stocks. Well, it's a very vibrant market and a lot of stocks are making big moves.
From corporate, we have Mr. Raj Jain, CMD of RS Software, joining us to take us through the business outlook as well as the growth drivers for the business. The stock is up a whopping 14% in the year-to-date graph. Will also come up for you on your screens, highlighting the kind of interest the stock has received. Mr. Jain, good to have you on the show. You're a niche player in electronics payments industry from which you derive bulk of your revenues, but you also have a considerable contribution coming in from testing, data analytics, as well as application management services. Give us a sense of the revenue mix going forward and what will be the key growth drivers for you in the next couple of years.
Morning, Tanvi, and morning, viewers. Thank you very much for having me on ET Now. You talked about the growth drivers. As you would well imagine, the analytics continues to be a major growth driver for the past 3 years now, in particular, and testing, which is Q&A, also continues to be a large growth driver. The payments industry overall stand at an inflection point where there's a major intersection of both cultural and technology taking place. And for instance, recently, if you heard in the news about the Chinese e-commerce company Alibaba, which has just got valued at about $187 billion by investment bankers for its IPO in the United States. Here in India as well, we've seen major valuations going up for e-commerce companies. And the switch that's taking place from physical payments to digital payments is significant for the world at large. And our software has played an important role in building the infrastructure for the physical payments. When I refer to physical payments, I'm talking about using cards primarily at the point of sale. You could be at a restaurant, you could be at a store, etc. So therefore, now the switch is moving on to online and mobile payments, and this whole infrastructure which has got to get built, our software is a core player in that, and we see a secular growth trend being reinforced for several years to come, and our software is extremely well founded for that area.
Right. Mr. Jain, basically you're saying that the size of the opportunity for a company like yours is large, but indicate to us how much of that opportunity can you actually, gain from going forward in terms of numbers, the kind of run rate you've clocked past couple of years, around 35% bottom line, 20% top line. Can you better that run rate, and what kind of profitability prospects do you see for the company?
Absolutely. So let me tell you, the opportunity is across the board in the entire segments of the payment industry for our software. For the issuers, for the acquirers, for the payment networks, etc. In fact, recently we have broken into one more major payment network. And as the investment community is quite aware that we currently have a dominance of a large client, single client concentration, and our key strategy moving forward, we've taken a conscious decision of that, is to de-risk ourselves by expanding on our clientele and at the same time working on expanding our margins. So the way I look at it is there's a three-pronged attack on our margin expansion. Number one is by executing more work or the lower cost locations like India. Number two is strategic cost management. We are right at advanced stage of implementing our ERP system within the organization. And number three, equally important, is to be able to look at use of tools and frameworks and reusability to accelerate the software development cycle. And finally, being a domain-focused company, we look at ourselves in the consulting space, which adds to the margins. When you look at this three-pronged plus the consulting piece, we look at continuing to improve our margins over the next several years to come. And that's really where our focus is. At the same time, de-risking and moving consciously away from a client concentration to looking at larger opportunities.
Fair enough. You've paid a dividend of about 6 rupees, on a 43 rupees per share EPS, which implies a dividend payout ratio of about 14%. making it lower than what the industry peers have done. Would you be working towards bringing about that alignment for your shareholders, because your stock has done well?
Sure. Tanveer, you are cutting it, but I think I understand your question. We are incrementally making a larger payout. We're very conscious of our investor community, which has been very patient, and we continue to see this trend on our part of trying to maximize the returns for our stockholders and for our new investors. So yes, you can continue to expect a larger appreciation for our investors through a combination of a good payout as well as a stock price appreciation, and obviously that's in the back of a continued good performance. Like I said, our focus expansion of margins and deconcentration of our client risk.
I'm afraid we are running out of time. One quick last question to you. You did about 30 rupees EPS in FY13, 43 in 14. Is it a fair estimate of the analysts that you may be able to cross about 55 to 60 rupees EPS this year?
Well, the analyst committee is always pretty aggressive in what they would like to see. All that I can tell you is we continue to do our very best, and we hope to see a certainly improved growth on our EPS at the end of this fiscal year, which should be a healthy double-digit growth.
All right, we leave it at that, Mr. Jain. Thanks very much for joining us and giving us that insight to your business. We wish you all the best going forward. Before we get in,